Let me know if you agree with this statement. Trump's going to break the market. It's going to be an absolute shit show sooner or later. It's kind of already starting to happen. But is Trump really to blame here? Or is this all just part of a business and market cycle and it's going to happen whoever happens to be in power at this time? Let's find out. Maybe pick a thing or two to help us better profit from what is actually happening in the markets right now. So look, if you've been in crypto for a while, you're probably familiar with the Bitcoin 4-year cycle. But you probably haven't heard so much about the business cycle or the economic cycle. You see, the Bitcoin 4-year cycle is loosely based on the halvings and what happens each year based on that. It predicts the ups and lows of Bitcoin and to an extent the whole cryptocurrency space. On the other hand, the business cycle is really the all-encompassing metric here that affects everything in the economy. So what exactly is it? Well, the business cycle is the natural fluctuation of economic activity over time. Now look, I know that sounds kind of vague. So imagine it like this. The economy is kind of like a big roller coaster. It has its ups, has its downs, and sometimes has its loops and terrifying drops. It's the natural rhythm of growth and slump, driven by stuff like spending, jobs, interest rates, okay? It's got 4 key stops: expansion, peak, contraction, and trough. Then it loops back and does it all again. Kind of like the Bitcoin 4-year cycle. Yes, this is the roller coaster ride that simply doesn't stop because economies never stop. The first momentary pause here for the cycles is in the expansion zone, or the start of the party. The economy's buzzing, businesses are hiring, consumers are spending a lot, factories are cranking up at full speed, the GDP's going up, everyone's having a good time. The second phase is the peak. The party's reaching its climax, inflation is starting to go nuts, wages can't keep up, markets are topping out, of course, no party lasts forever, so sooner or later we enter into the third act, the third phase, which is, of course, the contraction phase. This is when you start seeing people being fired from their jobs, orders drying up, consumer spending drops, GDP shrinks. This is the start of the recession. The fourth phase is the trough. This is the pit of despair. Unemployment is high, everything is just plain ugly, zero optimism for anything. Like any good party, this is the hangover part. This is where you are questioning all of your life decisions, maybe kicking yourself, of course, for selling the dog to buy that newest dog coin. At least if you had the dog, it'd be a companion during the dark times. So since the 1950s, the average US economic cycle has lasted about 5.5 years, though lengths, of course, do vary. For example, the peak-to-peak cycle from 1981 to 1992 lasted just 18 months, while the expansion that began in 2009 was significantly longer. The 4 phases are relatively easy to understand. However, the question is, which of course is the topic of this video, where are we right now? Well, if we're to believe Fidelity's latest business cycle update for the first quarter of 2025, what it is showing is that major economies are in late cycle expansion. And it seems like major economies like Japan, the UK, everywhere in the Eurozone, they are starting to reach contraction first. Now, it might be easy to understand how late in the phase we are if we take a look at some of the key indicators that are usually used to determine where we are. But before we do that, I want to take a moment to let you know how you can get $50 for free with Femex, one of the top crypto exchanges. Look, markets go up, markets go down, but you can trade both ways and make money both ways. Even if it feels a bit dirty making money shorting sometimes. And the OG exchange, Femex, is a great place to do it. It's available to everyone, everywhere. It has deep liquidity, all the top trading pairs, and currently they're running a crazy promotion that you may want to take advantage of. So you get $50 for free just for signing up using the link down below. You'll get a 20% deposit bonus. So you deposit $1,000, get $200 back, as well as a $1,000 trading bonus. Pretty damn cool, right? All you have to do, use the link down below to start your account and you'll be eligible for all of those bonuses. Go check it out if you're a trader and you want to be trading in the markets and taking advantage of that offer, but also of all the trading opportunities available. Let's talk about the ISM Manufacturing Index, or the PMI. This is a key indicator of U.S. economic activity based on a monthly survey by the Institute for Supply Management, or the ISM, of purchasing managers in the manufacturing sector. So this measures changes in production levels across the economy, and it includes all kinds of key components: new orders, production, employment, supplier deliveries, inventories, all that kind of stuff. Now, PMI above 50 indicates expansion. A PMI below 50 suggests contraction. Now, this index is released on the first business day of each month and provides a lot of that early insight into the sort of broader health of the manufacturing sector and the overall economy. Now, reading above 50, again, that shows that the economy is expanding. Things are generally going good for business. Okay, and when we're under 50, problems are starting to show up, stresses are starting to happen. So in February, just a couple days ago, yesterday actually, maybe a couple days ago, the PMI was 50.3, slightly down from 50.9 in January. For comparison, it was 49.2 and 49.4 in December and November, respectively. Notably, the PMI was below 50 for 26 months prior to January. This recent improvement with 2 consecutive months above 50 is actually pretty promising, despite the slight dip recently. I know tariff headlines and stuff got the markets way spooked out, but here's a little bit of signal for you, okay? There's another similar survey, the S&P Global US Manufacturing PMI, and the numbers are actually pretty good. It's 52.7 in February, up from 51.2 in January. That's awesome. That's a 32-month high. Now, that's pretty good. But of course, there's a caveat from the same report. According to S&P Global's chief economist, Chris Williamson, companies are actually stockpiling, and that's what kind of pushed the metric up in order to dodge tariff hikes and supply nags, and the number is not because demand has gone so wild. Another indicator is copper. Yes, again, good old copper, not gold. Copper. Basically, copper is an industrial metal. It's used for almost everything from power lines to cars, down to your smartphones and basically everything. An increase or decrease in copper demand will tell us if factories are actually slowing down or ramping up. So we also have some good news on this one. You see, right now, the current price of copper is on an upward trajectory. Last December, copper was trading below or around, let's say, $4 per pound. And at the time of recording, it's trading at around $4.50 per pound. So the PMI and copper demand are telling us things aren't as bad as you may see with all the panic going on in the market. They're kind of telling us there's more room for the economy to expand, and the unemployment report is actually agreeing. Now, the unemployment report for January showed that the unemployment rate decreased to 4%, near historical all-time lows for unemployment. By the way, that's a slight decrease from the previous month's rate of 4.1%. Now, of course, there's a fear that because Elon Musk and Trump are firing a bunch of government workers, that might spike in coming months. And of course, being in crypto, we all know that sentiment plays a big role in the price of assets. Unfortunately, things are not looking super great on that front. The Conference Board's Consumer Confidence Index dropped to 98.3 for February, down nearly 7%, and below the Dow Jones forecast of 102.3. Now, this is the largest monthly drop since August of 2021, which came just before stocks rolled over and we had kind of the 2022 recession, although they didn't technically call it a recession, but it was basically a recession. This means consumers are worried about future business conditions and about future income. Is it just a growth scare? People just freaking out a bit early? Maybe. We'll see. Now, all this also affects spending habits, and of course, we'll have a negative feedback loop on the economy. When people are more afraid, they spend less. The S&P 500, considered to be the barometer of the U.S. economy and to an extent the global economy, this index has been showing a very strong performance, of course, in recent months, although cracks are starting to appear. Okay, we had a big expansion phase on this, but then the new highs started just being a tiny bit higher. We sort of saw momentum slowing down. It's having a pretty hard time staying above 6,000, okay? Currently, it's just below this number, and with all the fear in the markets, by the time you watch this video, it might be even further below that number. Now, this gives credence to Fidelity's report that we're actually in the expansion phase, but closing time might be getting closer than a lot of people would like to think about. And as for the GDP, we have good news, we have bad news. The U.S. economy showed moderate growth in the fourth quarter of 2024, with a 2.3% increase in real GDP, which is freaking awesome. Good job, America. Good job, America. Problem. Some bad news here. The deceleration from the previous quarter's 3.1% growth actually indicates a potential slowdown coming here in economic activity, okay? So we want to keep an eye out, of course, for the next report by the end of March, which will show us real GDP data. There are estimates already coming out, predictions coming out that GDP is actually going to drop about 2.5%, which would be a 5% drop from the highs of 2.3 down to minus 2.3 or whatever they're kind of predicting right now. So if there's a further decline, then that's another reason to believe that we're getting pretty damn late in the expansion stage here and that we could be seeing extreme economic turmoil coming. Now, at the start, of course, we want to know if the president has something to do with, of course, possibly the end of the expansion phase, or if it's just simply inevitable. This is what he inherited. Gonna have to fix it. Has to deal with the bullshit until then. No matter who is sitting in the Oval Office, this is stuff that's gonna happen. Now, according to this chart by Bravos Research, the S&P 500 sees on average 40% higher returns under Democrat presidents. But before you go and say, okay, well, there you go then, there's your answer, Republicans suck for the economy. It should be noted here that many Republican presidents, Hoover, Nixon, Bush, they actually came to office near the peak of business cycles. So for them, they just were dealt a bad hand of cards. There was really no way to go but down. Now we can argue these presidents fumbled the ball. They could have handled it better, which is why the expansion was not extended. But let us put that conversation for another day. So why does all this even matter? Look, us regular people, we can't, tweak a president's economic playbook or change the titanic forces that are at play in the economy here. But what we can try to figure out and what we do have control over is our own personal portfolios and try to understand how this is going to hit us, especially, of course, for cryptocurrency investors. Look, here's the deal. Stocks and Bitcoin move together because of geopolitics, economic vibes, you name it. Our correlation to stock indexes is incredibly high. The business cycle, of course, proves this. We're in expansion mode right now. Stocks, Bitcoin, and crypto, of course, have been on a tear until, well, the last few damn weeks, haven't they? There were a lot of all-time highs smashed and then kind of down only for a lot of things in the last few weeks, including stocks. And I know Bitcoin was a real tease when it hit $109,000. Can't believe if that was the cycle top. What a lame cycle, man. But it's been giving us the runaround with S&P 500 slowly declining and Bitcoin just having incredible sell-offs, Ethereum puking its guts out. But for a lot of reasoning, the party's still on, but it won't last forever. Signals are mixed. Manufacturing's hot, PMI's up, copper's buzzing, jobs are still surprisingly solid, yet consumer confidence is getting pretty damn wobbly. Tariffs are freaking markets out. Declining GDP could be a real problem if that's confirmed. The S&P 500 is stumbling, the NASDAQ stumbling. People are losing their minds, and the fear is real. Now, if we go back to the comment from S&P Global Report, the increase in PMI due to tariff fears. Look, I'm kind of with Fidelity on this one. We're probably in the late expansion phase. The question is it finishing in a week, in a month, in 6 months, 2 years? Because it still could go for a long time, but we're heading towards the contraction area. Bitcoin still has some runway. We're only 300 days past the Bitcoin halving. Peaks usually hit around 500 days, so around October of this year. A lot of cycle indicators like the Pi cycle top indicator, Peel multiple, Nuppel, all saying basically mid-cycle. No red flags on those indicators yet, but maybe none of it matters anymore. Everything's just too macro driven. The strategic Bitcoin asset reserve, it's still coming, guys. And look, I have no crystal ball, and I could be completely off here, but here's my take. Probably, once the worst of these local fears are over, markets turn around, we have the chance to keep grinding higher into the end of the year. The M2 money supply, still very strong signal among all this noise. It's showing an increase in risk asset prices. Tariffs, of course, are going to drag everything down, potentially by really big time in 2026, but short term, of course, the news really hitting markets hard. So am I panicking? I'm not panicking, you're panicking. Maybe a little bit. No, we're shit. Anyway, this fits the crypto community's sort of general ideas. Okay, when indicators flash sell, Pi cycle, all that stuff kind of for Euphoria Max and people calling for $1 million Bitcoin price. The time to sell everything is going to come, at least for altcoins. You can hold your Bitcoin multi-cycle if you're okay with the volatility, but probably not the end of the cycle, although we could be in a choppy period for longer than a lot of people expect. Okay? But the next time you see altcoins going crazy, understand that it could be the final hurrah and that you're gonna need to take damn money off the table. Between now and whenever the markets reverse, could be a lot more pain. So be ready for that. But the bigger signal so far showing that the business cycle is not over, according to a wide variety of metrics. There could be slowing down of the business cycle. There could be slowing down of a wide variety of factors, but it's not over yet. Once we get past the growth scare, the tariff fears, M2 could pull the markets higher in April, May, June, for example. Things could be closer to turning around than you think. Or we go straight to Goblin Town. I'll see you guys back in 4 years. Jury's still out on how it's all going to play out. But from most of the indicators we're looking at, still fuel left in the tank for this market cycle. Okay, nothing is for certain, and things can always get more dramatic before they get better. Remember, keep your leverage low. Spot bags will help you sleep at night, okay? And understand that crypto's not going anywhere. Look at everything that's happening right now. Crypto's only going to get bigger. Short-term pain, long-term gain. Thanks for watching.